Welcome, I'm Stephanie Ford from Beacon Group Real Estate. We're happy to talk with you today about the model that we use to calculate real estate returns. We enjoy giving our clients tools to make rational decisions about their real estate. We find that this tool in particular gives people a multifaceted way that they had not considered before to evaluate their investment property and the decisions that they need to make. We have a separate presentation that we use with clients to evaluate the role of their home, their primary residence within their real estate portfolio. We feel that it's important to consider their home part of their overall asset picture in their investment portfolio. But using this type of model, this investment model, is not the way, in our opinion, to make that evaluation of how your home fits in that role. We do a separate presentation that talks about the role your home plays over time, and how that your home is part of your overall nest egg, your asset portfolio, but that this presentation specifically is geared towards your investment property. What we're looking to cover here in talking about investments, when we talk with people about real estate investments, we want to make a comparison between investing in real estate and other investment choices that they could make. We try to separate those. Many people will say that real estate is always a good investment or it should be part of their portfolio, but this tool is a way to give a concrete comparison between different types of investments, comparing your real estate investments to CDs or bonds or stocks or other investments, and to give our clients tools to make that evaluation. A question we get frequently is, what is an ideal investment property, or how to identify a good investment property so then I can just go collect those? And the answer is that there is no one ideal property for everyone, that different properties will meet different goals at different times in people's lives or as a different kind of property in a portfolio, and we strongly recommend to evaluate each property and how it meets the goals and how it meets the situation you're in at that time. We'll touch on how the Boston real estate market is different from other places and how that impacts the investments, and then some of the concerns that people have about the risks of real estate and the problems that may come up over the long term. I think often when people talk about investment returns, the most common things that come to mind are sort of your cash investments of your CDs, your money market, your bonds, cash-ish, and they start getting less cash toward bonds, stocks, tech stocks, high-flying things, higher risk, higher reward, higher potential reward, etc. But people don't always know where to slot in real estate into comparison with these other types of investments. Your cash right now is down around very low interest rates. You move into bonds in this 4, 5, 6 sort of range. S&P historically is at an 8%. You have your higher performing stocks out here that you hope to hit the home run with. And where does the real estate fall? I think people frequently have a hope that a real estate is going to be out here exceeding this, and a lot of times people set themselves up to be limited to returns worse than cash. So we're looking to help people evaluate the plans that they're making and the goals that they're setting, and to give them tools to both measure their returns and to set themselves up for success. So when we talk about real estate appreciation and talk to clients about what they hope to achieve or what they have achieved or what other people have achieved, we find a big variation in what those returns are and how people approach calculating those returns and making those decisions. If we ask any group of people, I think they're surprised to hear what is historical real estate appreciation. If you look on the biggest level across the longest time, what does that number come back to? And the biggest thing that we have to tie it to is we have a few hundred years of capitalism. We have markets like New York and New York and London and Amsterdam that have had this capitalist infrastructure in place for a long time and property ownership for a long time. and how have those values changed over time? And the answer is, according to research and studies that have been done, that there are fluctuations, there are things that impact values, the Industrial Revolution, the implementation of railroads, the car has changed things, and there are swings in value based on that, but the number always comes back to a shocking 3%. That it runs very closely to inflation, and that there is nothing particularly magical about real estate that makes it an investment radically different than any other. That's not completely true, and the mystique of real estate is because there are things that are different. One of the biggest differences is it's a product that you can use. It's an investment that you can use, that you can live in, and it is different from buying a stock that either does well or goes bankrupt and is worth nothing. So there's some fundamental value, and the things that you feel are special about real estate, there is something behind that. It is a special kind of investment, but it's not special just because it goes up in value a lot, whatever a lot is. It can be an investment vehicle in several ways, and that's what we want to look at today. Real estate itself, while I say that the value of real estate goes up an annual return of, say, 3%, what we want to encourage our clients to strive for is a real estate investment return of at least 10%. And I say at least 10% because we want to be beating the S&P. If we're not beating the S&P with this effort that we're putting into real estate, into something that is not liquid, that takes time, that has risk, that involves you, then why aren't we just buying index funds and throwing in a few tech stocks and calling it a day? Why are we bothering with real estate? And the answer is that it isn't the real estate that we're buying and waiting for it to go up its 3% and maybe it bumps up better here and there. What we're investing in is an investment vehicle that includes real estate. It is real estate, it is an income stream, it is maybe a financing package altogether that gives you a return. And that's what we're looking to package and invest in. So, moving beyond the idea of property is something we buy that just goes up in value, what is an ideal investment property? What are these other pieces that contribute to what a property is worth, what an investment is worth, and what my returns can be? And one, I'm blanking on the word for this thing. Acronym. Thank you. One acronym that we use just to bring in the different aspects of an investment property, ways that you can make money, is ideal. That is that there's income that is coming in, rent that's being paid. There's depreciation, which is a tax tool that can be beneficial. There's equity growth coming from the tenant paying down the mortgage. So equity growth separate from appreciation. Then there is appreciation. The value of the property does tend to go up. And one of the very important tools is the leverage. And that's one of the unique things about real estate, is that you can borrow money to buy real estate so that your gains, your returns are multiplied. They aren't just increased, but they are multiplied. Let's look at each of those. Let's look at the different ideals. So cash flow is the one that most people, a shocking number of people, including myself, will say that their goal is cash flow. I want to get $1,000 a month out of this situation. And people will throw that out no matter what the investment is, no matter what the the equity, the contribution that you have going in. I need to get $1,000 a month going out to make it worth my time, to make it feel like a good investment, etc. And tons of people will tie themselves to that number. So that is different from return. That's different from, am I making a good investment with my money? If I put $5 million into a CD and got $1,000 a month out, I wouldn't be happy. And I'm using an exaggeration to bring the point, and most of you are thinking, I'm not investing $5 million, I'm investing $50,000 or $500,000. But if I look at, I put in $50,000 to this investment when I bought it, 5 years ago, 10 years ago, 20 years ago. Therefore, when I have this $12,000 in income coming in on my $50,000 investment, my cash on cash return is 24%. And that sounds amazing, and that must be pretty good. But is it amazing, and is it true? So what is the income? The property generates rent. If the rent exceeds the expenses, you get a paycheck every month. That is the cash flow. A cash flow of $1,000 a month means that the rent coming in is $1,000 a month more than all of the expenses that you have to pay out. So if I put down $50,000 10 years ago when I bought this property, and I say that my cash on cash return is 24%, is that true? Well, if my equity today isn't $50,000, but it's $500,000, my cash on my equity, my $12,000 income as a return on the equity that I have in the property is only 2.4%. So I've gone from a 24%, like a high-flying tech stock, to a 2.4%, like a CD. CDs may be worse than that right now, but you get the idea. Maybe a bad bond investment. So that's one thing to keep in mind. We'll circle back on each of these and give some examples. Depreciation. Depreciation is hard to get a handle on. This is exactly how it's going to benefit someone because it is so dependent on your tax situation. If you're sitting at a holiday dinner with all the relatives and they're talking about investing in real estate, they may, and they've had real estate before 1986, they're going to see depreciation as this amazing gift. If they had it through 1986, they're going to call it a complete sham. And in more recent years, it becomes worth less and less to people. However, it's still a good tool. We'll include it in our calculations. The IRS does, and it is part of the overall picture. Equity. I touched on this just briefly. Equity and appreciation are related. Equity, we'll use specifically to talk about as the tenant pays down the mortgage. So the tenant is increasing your equity position just by paying the mortgage, independent of the property going up in value and independent of cash flow. This just happens. Appreciation is a property increasing in value. And I see people want to say shocking things about how much their property appreciated and therefore how much a return is. So people will talk about, oh, I bought this property for $1 million and I sold it for 1.2. I got this amazing return. Well, what is your return? And a common one I see with this is, grandma sold her house for 10 times what she paid for it. Or the city of Cambridge quoted recently, real estate values have almost doubled in 20 years. Well, I hope so. And that's just about inflation. That's not a lot better than inflation. So working out what these timelines are and what these returns are, I think is insightful. So if you buy this property for $1 million, you sell it for 1.2, what is your return? If you have a gain, and we'll call this, your net gain after expenses, say, is $200,000, is that a 20% return? So it depends on the time scale. If you bought this property and sold it within 1 year and netted $200,000 on your sale, then it does look like a tech stock. It looks like you made 20% return on that investment for that property. However, if it takes you 5 years to get to that 1.2, then you've dropped down into the bond range. You're in like a 4% range instead of a tech stock. If it takes you 10 years, you're down around inflation, perhaps, and it gets worse as you go. Many people will hold a property until it gets to a certain dollar number, or just hold it because they're going to keep making money, but not keeping track of how their returns are performing over time. And it is frequently the case that it's diminishing returns. The money made on a property is often made in the first 5 to 10 years, That number varies based on economic conditions, but holding it for more than that, especially without refinancing, is usually diminishing returns. And we can model out that expectation, and we can also track and see how it's going in real time. How does leverage play in? I'm going to bring in leverage right behind the appreciation to see how it multiplies a return. When you buy that $1 million property, if you don't invest $1 million, but you only invest $200,000 because you got a loan, because you leveraged the rest of it, and then you sold it and made your $200,000 return, if you only put $200,000 in, then you get $200,000 out in a year, you've doubled your money or made 100% return. That's 5 times the amount that you made without the loan. That's leverage. Your return is 5 times as much. It's not cleanly that because all of the math is a little bit different, but the idea is definitely that. It multiplies the return that you make on an investment. And that is something that you can't do with any other kind of investment. That is the magic, or one of the kinds of magic. You go out 5 years, it takes you 5 years to get this 200 back. You're still in the double digits of return. And that's what we're hoping for. You go out 10 years, maybe you're at bonds at 10 years. And beyond that, then you see the diminishing. An obvious fallacy, I guess, within the chart is that as time goes by, this price should continue to go up. And what we will model is what these returns look like as the price goes up. And you have the costs of expenses and the loan, etc. That's what we're looking to model, is to get people a way to fully calculate that and understand what their return is.